Welcome to Catalyst. I'm Seana Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down the outlook for U.S. stocks as investors turn their attention to Europe. Will consumer sentiment change the trade?
Plus, we push ahead to Nvidia's results as the AI chip giant gears up to report. How will Wall Street respond?
And we break down everything Warren Buffett bought and sold last quarter ahead of a big weekend for Berkshire and Buffett.
The final reading of February's University of Michigan consumer sentiment data crossing the wires right now. And you're looking at the number actually falling here, the index falling to 64.7. The estimate was for 67.8. That was the preliminary reading that we did get. The prior month's reading was actually 71.7. So we're looking at a pretty dramatic fall here over the past month. Expectations index falling to 64 flat. That was down from 69.5 the prior month here. When it comes to current economic conditions index, that also declining during the most recent month. Now, the expected change in median prices, this is the real key here to this report, during the next year, that actually rose to 4.3%. We talk about the fact that consumers are a bit more worried about inflation, what exactly the prices are going to be. That was versus 3.3%. It's the highest level that we've seen since November of 2023. The expected change in median prices during the next 5 to 10 years, that actually rose to 3.5%. So, Maddie, that very much is consistent with what we did get in the preliminary reading, just showing that consumers are a little bit more weary and a little bit more worried about what they're seeing in terms of inflation.
Yeah, and it's really interesting to see those inflation expectations ticking up really across the board and not just along those political lines, which is something we had seen post-election. I want to take a look at the market reaction here. All the major averages continuing to be under pressure. We also got that manufacturing data this morning coming in weaker than expected, which also put a little bit of a dent in the market rally we'd seen earlier in the week. You got the S&P down about 0.3%. Your tech-heavy NASDAQ down nearly 0.2%. But let's take a look at what we're seeing when it comes to treasuries. Again, after that weaker manufacturing data, you did see yields coming in, and you're seeing a continuation of that with the 10-year hovering around 446 there, down about 4 basis points. Interesting to see that in the context, too, of just the focus that the Trump administration has had on the 10-year yield. We are continuing to see that coming in here off of this weaker than expected data, specifically when it comes to that consumer sentiment data and also the manufacturing data falling quickly. Just want to mention employment falling specifically in that manufacturing data, which could be a negative signal of what's to come in the labor market. We're going to discuss all of this and more with Matt Norton, Raymond James Chief Market Strategist. He is joining us now. Matt, great to have you on. Talk to me about your reaction to the consumer sentiment data and how the market is digesting it as well.
Hey, good morning, Madison. Great to join you. And I think we need to look at all of these surveys with a grain of salt because they change very, very rapidly. And I think there's a number of drivers, especially with respect to the noise that we're getting out of Washington with tariffs. There's also some near-term inflationary pressures with respect to food and egg prices and all of those things that consumers see on a daily basis that I think is really influencing their perceptions of where inflation is going to go and where sentiment is right now. But when you take the bigger picture, and this is something I emphasize to clients, is that the one thing that matters most to the market over the long term is what's happening with earnings. And I think we're forgetting, because of all of the noise that's out there, just how good earnings season has actually been. S&P 500 earnings are up almost 17% year over year, which is significantly higher than expectations. And critically, earnings breadth continues to increase. So you're seeing better earnings across sectors. Financials are the best contributor to earnings growth so far this year, but also down market cap. So areas of this market that I actually like, that I think benefit from the stronger fundamentals underlying this market and economy, or small caps, mid caps, all of those parts of the market I think make a lot of sense to look for on pullbacks that I think are based on some short-term indicators.
Matt, is it going to be enough, though, to offset the underperformance of the Mag 7?
Yeah, and so far it is. I mean, our markets are sitting pretty close to all-time high, Seana, and I think we lose fact that the Mag 7, even though they're starting to underperform relative to the market, they haven't completely rolled over in totality. There's still certain names in there that make sense. And again, the big takeaway from all of this is that selectivity actually matters again. It matters what you own. You might not want to own all of the Mag 7, but there might be one or two companies in there that still are continuing to do well beating earnings, have good prospects going forward. But there's a lot of areas like financials. Banks have done incredibly well. They benefit from deregulatory trends and the fact that the economy remains in a good shape. Even healthcare, I know there's issues with respect to the DOJ, but you look at medical devices doing quite well. The rest of healthcare today is actually up outside of managed care. So there's a lot of other ways you can diversify your portfolio away from the Mag 7, and the market is holding up because breadth is expanding.
But how much should you be diversifying away from the Mag 7? I get what you're saying about selectivity, but the last 2 years have taught a lot of investors that you can't really afford to not properly allocate to the Mag 7.
Yeah, it's a great point, Madison. And I think people forget too, even if they're just index investors where you own SPY or the Qs or any of the general market ETFs, you own the Mag 7 in a pretty decent weight. So I wouldn't say that the name of the game is underweighting or not owning them. I still think these are fantastic businesses. I mean, when you look for a high quality business, most of those Mag 7 companies are the perfect definition of quality. So I think you still want to own them. But I think what makes sense in this market is when you're looking to perhaps put some of the excess cash that you have on the sidelines to work in the market, or as you rebalance your portfolio and maybe think of just taking the weight slightly down from the winners that you've had in the past and rotating into where the earnings growth are actually going, into places like financials, down market cap into mid caps and small caps, even overseas. There's definitely opportunities internationally to help diversify your portfolio. And you also get a little bit less tech exposure that way too. And banks overseas are doing great as well. The name of the game is balance. How are you as an investor going to build better balance for your portfolios in 2025? Because I think that's how the market is going to unfold.
Matt, how much volatility do you expect Nvidia's earnings to introduce into the market next week?
The market's expecting significant volatility. We've seen that play out every single time. So all eyes on Wednesday afternoon are going to be on what happens. And it's not even so much the results, it's how good is the guidance. Is guidance going to exceed already high expectations for the market? And that is what's going to determine the price movement going forward. And again, regardless of what happens with Nvidia, I think they're going to still confirm the AI trade is firmly in place. And I think that opens up opportunities as you look to diversify into software. Some of the other AI halo names where earnings are good but got taken down because of DeepSeek, like your data center build out plays. There's going to be opportunities. And so you want to digest any volatility introduced from Nvidia and see where else you might be able to put money building on that theme of balance.
Let's stick with that because, and you mentioned this in your note too, that there are opportunities in AI capex beneficiaries. You mentioned their software. Can you get a little more specific for me?
So yeah, I think as you look at where expectations are for results and monetization, software is really the next phase. So it's not necessarily in the big behemoths of software, but when you look down to smaller, maybe smaller, large companies, mid companies, cybersecurity is top of mind. When you look at an environment that we have right now with more and more threats, more and more cyber threats, when I talk to CTOs of companies, a big line item of spending that's actually remained pretty steady over the past few years and actually starting to increase right now is on cyber defense and leveraging AI solutions within cybersecurity. So you want to own some of the cyber companies that are levered towards the best and more differentiated AI plays or AI integration. And so those names have been doing well for a very good reason. So that's one good place to continue to look or lean into as this market continues to be a little bit choppy in the near term.
Matt, real quick, let's talk a little bit about the Fed. I guess, is from your view, is the Fed in a good spot right now? Is there a risk potentially of waiting too long to act again?
Yeah, Seana, everyone loves to be, I think, an armchair economist with respect to what the Fed should or shouldn't do or what they did wrong or didn't do wrong. I think the Fed's in a fine place. The Fed has set themselves up to wait and see, and that's the exact right approach, at least I think. The economy continues to be robust. There are some cracks that are starting to form, nothing that's opening up into fissures. There's inflationary pressures, but it's all so far in the short term. So we've got to wait and see where the data comes. And I think the Fed has been very proactive in giving that message to the market, which is perhaps why once we made adjustments earlier this year with respect to rate cut expectations, we've seen the 10-year pull back. And I actually encourage clients, if you get the 10-year yield above 4.85, nearing 5%, that's the time to think about adding duration, because I don't think rate hikes are on the table. And I think the Fed's in a very good place to just wait and see how things unfold.
I want to end by talking to you about the Europe trade, which has gotten a lot of attention this week. And you noted that the growth rate for U.S. earnings was around 9%, only about 6.5% for Europe. So how should investors be thinking about the opportunity in Europe when you aren't getting paid as much to sit in European equities?
Yeah, that's a really good point. And I think when you look at diversifying into Europe, especially after the big run that European equities have had over the past, call it 3 months or so, I think you want to wait for a pullback to put some money to work. But you can be opportunistic. The name of the game is selectivity, because not every part of the European market is moving up in tandem. So you want to be careful of what sectors, call it your industrials, material companies, might be more levered to tariffs or to challenges that might come up with respect to China. And instead lean into trends that you know are going to be important. Ceasefire in Ukraine. Whether or not that happens, we know countries have to spend more on defense. So there's a reason why European defense companies' earnings have been good. Lean into that. Banks are doing better because the economy looks like it may have bottomed, and you're seeing good earnings come back. So again, it's always follow the earnings as you're looking overseas and wait for pullbacks. There's no need to chase this market higher.
All right, Matt Orton, great to talk to you. Thanks so much.
Thank you.
Let's do a check on the markets here, just about 41 minutes into the trading day. And again, you're looking at losses here, a bit of a pullback from those record highs that we saw earlier this week. And now you're looking at the S&P dropping once again here this morning, off nearly 0.3%. The reading that we just got out at the top of the hour, University of Michigan's Consumer Sentiment Index falling further here. Lots of concern and questions here from consumers about inflation expectations, those rising sharply, consistent with what we saw in the prelim report. But again, that's adding maybe to that negative sentiment out there on the street this morning. Flipping over to the bond market as well, when you take a look at the 10-year yield, dropping just a bit here, off 4 basis points to 4.46, Maddie.
And before we go to break, just want to level set. Take a look at where strategists expect the S&P 500 to close out for the year in the context of where we are at right now, hovering around the 6,100 level for the S&P 500. The average price target for the street is 65.70. We got a street high of 7,100 and a low of 5,500. That average price target implies just a 7.7% move to the upside from where we currently are. That obviously pales in comparison to those double-digit upside moves that we've all grown accustomed to in the last 2 years. So it'll be interesting to see what that 7.5% move potentially looks like and why we don't see broader gains if that does end up being the case for this year. And just to run through a couple of the big bank calls, Oppenheimer has your street high, 7,100. A lot of big banks at 6,500. That's Goldman, Citi, JP Morgan, and Morgan Stanley. And then you got a lone bear calling for the mid 5,000s. We will call it 5,500. We'll have more catalysts for you right after the break.
The University of Michigan's Consumer Sentiment Index falling sharply in February amid a jump in inflation expectations, the biggest jump that we've seen since 2021. Joining us now, we want to bring in Joanne Shu. She's University of Michigan's Director of Surveys of Consumers. Joanne, it's great to have you here on Yahoo Finance. Talk to me about this massive uptick that we're seeing in inflation expectations and what this signals just in terms of what the months and years ahead could potentially look like.
What we're seeing is a very broad-based conclusion or opinion among consumers that inflation is going to pick up in the year ahead as well as the next 5 years. It was a pretty large month-over-month increase for both short and long-run expectations. It's not necessarily cause for panic at this moment, but these expectations are clearly being driven by concerns over policy, concerns that tariffs are going to lead to price hikes. And it's very anticipatory on the basis of consumers.
How is that playing out across political orientations? We saw after the results of the election a direct flip where Democrats' inflation expectations rose, Republican inflation expectations moved in the opposite direction, indicating similar sentiment to the election results going in either party's direction. What is that sentiment telling you?
Partisan differences in sentiment and in views of the economy are longstanding. So what we saw following the election was exactly what we expected. And that's one of the reasons why it is absolutely critical to look at independents. So independents don't really have a break around the election, and they're usually generally right around the national average. And critically, what we saw this month was that independents had a decline in sentiment as well as Democrats. And they also saw the big hikes in inflation expectations. So the changes that we saw this month relative to January, they're not just being driven by Democrats. We see it critically among independents.
Joanne, is this a trend just from who you have spoken to and obviously comparing it back to prior readings? Is this a trend that you expect to continue?
The trend, if you're talking about the fact that people tend to have higher levels of sentiment when their party is in power in the White House, yes, we do expect that to continue. It's been that case at least since the Reagan administration.
Joanne, more so the inflation expectations, and just given the uncertainty out of Washington and kind of the whipsaw action that we've seen headline-driven wise, how is that potentially? Do you see that being factored in here as we look to the future?
Sure. So the last time we saw such a large increase in inflation expectations, long-run inflation expectations, was in 2008. But times were very different at that time. Inflation expectations then were really reacting to oil price shocks that hit all-time historic highs in June. And then they waned right after that. They plummeted right after that, and so did inflation expectations. This time it's completely different. People are not reacting to current price shocks. They're reacting to anticipated price shocks. And so it really remains to be seen if these inflation expectations will stick. It really depends on what kind of tariff policies are rolled out and whether or not that trickles down to consumer prices.
Joanne, obviously you can give us great insight into this survey, but you're also an economist in your own right. So I wonder if you can put this survey into context for us. How does something like consumer sentiment, inflation expectations impact the real world economy, especially in the context of the last few years where inflation expectations have been rising, like you said, but consumers have continued to be relentless in their spending regardless?
I think what we should know when we look at consumer spending is that consumers have been supported by strong incomes over the last few years, in spite of all the other things that are weighing down their views of the economy. And the other thing is that sentiment hit an all-time low in June of 2022. And since then, it was more or less on an upward trajectory. And that's consistent with the strong spending that we were seeing. People were seeing that inflation was slowing. They weren't feeling great about the economy, but they were feeling better about it than they were in June. Right now, we're in a situation where sentiment is starting to decline and consumer expectations over the economy are deteriorating on a number of dimensions. So the upward trend that we had been seeing between 2022 and 2024, it's not looking right now like it's necessarily going to continue. But again, it's been 2 months of declines. It's really too soon to tell if this decline is going to be persistent to the long term or not.
All right, Joanne Shu, great to get your insight. Thanks so much for joining us here today.
Thank you.
Now let's get to some of today's top trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. Do that Yahoo Finance's trending tickers page. First up, let's take a look at Coinbase announcing the SEC, Securities and Exchange Commission, will be dropping its case against the cryptocurrency exchange. The SEC originally brought a case against Coinbase back in 2023 under then Chair Gary Gensler, arguing that certain crypto assets were subject to existing security laws. Now, in a statement, Coinbase is saying, quote, "It is critical that we pass legislation which provides a long-term certainty needed for the U.S. to lead in this industry," end quote. Again, that has very much been sentiment that we've heard from a number of investors, and we've heard from a number of others that are involved within the crypto space, just in terms of the need for clarity and transparency here moving forward. But again, this done under the Trump administration, very much crypto has been looked at as a huge beneficiary under the Trump administration, and what that lighter regulation overall is going to look like, and the fact that they are expected here to further prioritize or put more of a priority on crypto adoption.
Yeah, it's certainly a bullish signal for those crypto bulls out there who thought that this administration was going to be friendlier to the digital currency. And sure enough, we get a decision like this. We should note that this still requires a commission vote, so it's all but official at this point. But this had been essentially a move from the SEC to regulate the company as its own stock exchange. And as early as last week in Coinbase's earnings, they had this shift away from having their own crypto assets be part of their balance sheet. They moved that off, so it looked like they had this huge drop in revenue on their balance sheet, but really they just indicated this shift away from the fact that they own those assets, making it more clear that the consumers own those assets. That's more similar to what you see brokerage accounts doing on their balance sheets. So it was interesting to see that in the context of this decision today, that they are already already kind of moving in this direction, but I think it points to the lack of clarity that we have about regulatory pressure on these asset classes and what that is going to look like in the future, though this is certainly a signal of the SEC under this administration potentially being kinder to crypto more broadly. Next up, Meta is approving an increase in executive bonuses following staff cuts of about 5% or 3,600 workers. That's according to an FCC filing. The tech giant raising its target bonus percentage for certain executives from 75% of their base salary to 200% of their base. That'll begin this year. The filing did not include Meta CEO Mark Zuckerberg, and this comes as the Financial Times reports that Meta is reportedly cutting stock options for staff by about 10%. And again, after those layoffs earlier this year, a very small proportion of the staff, about 5%. And David Kelly from JP Morgan talked about this idea that you see a lot of the big tech firms instituting layoffs in the beginning of the year, perhaps around the time of year that people are having conversations about raises. You can kind of prevent the rest of the staff from increasing their raises and their salaries by instituting layoffs and inciting concern about the company's financial well-being, and that is partially why we do tend to get a lot of layoff news early in the year, but it's certainly interesting context when you are announcing increased bonuses to executive staff after cost cuts for the rest of the group.
It is. But I also think you could justify, right, when you take a look at the outperformance of Meta and how far and how fast that stock has come here over the last 12 months. And even since the start of the year, we talk about the fact that much of the Mag 7 has been losing its momentum. But when you take a look at Meta and the contribution that it has made here to the S&P's gains since the start of the year, it has been able to keep up some of that excitement. So again, when you take a look at the higher payouts, especially on the back of such a massive year here for the company, of course, that then helps them justify that. Over the last month alone, you're looking at gains of just about 13%. But again, going back just a little bit longer there, you'll really see the staggering gains that we've seen over the last year. As I pull this up here, you're looking at gains of just about, 49%. 5 years, you're looking at significant gains. Year to date, you're looking just around 20%.
Yes.
Finally, let's take a look at Alibaba adding to yesterday's gains. It's up once again today, following bets that its AI moves are paying off. Now, the move higher today also coming on the back of a journal report yesterday that GameStop CEO Ryan Cohen increased his personal stake in Alibaba. Now it's worth about $1 billion. You're looking at a move higher of about 6% here today. Alibaba is also reportedly eyeing an investment in fellow Chinese company DeepSeek, which promised in a post on X that it will be revealing 5 open source code repositories there coming up next week. But again, the big takeaway is this AI investment and really what the AI focus and what that has done to reignite some of that lost excitement surrounding Chinese tech giants, surrounding their advancement and their ability to compete with some of the larger players here in the U.S. We certainly saw the reaction to Alibaba's results yesterday. It's carrying over once again in today's trading action as well.
Yeah, I mean, it makes sense given the bullish action that we've seen in Chinese tech, specifically all of those CEOs, including Jack Ma, meeting with Premier Xi Jinping earlier this week, indicating a bullish sentiment around tech stocks in China more broadly. You can see the huge run in Baba stock over the last 5 days. But I do want to zero in on DeepSeek promising to share their open source AI code, because that's something that OpenAI was doing in the beginning and that DeepSeek was able to train itself on. So I wonder if we're sort of going to get into this meta moment where we see the DeepSeekification of DeepSeek's own AI source code moving forward, and if that is going to lead to even more affordable AI models, if they can iterate off of what DeepSeek already has, utilizing their open source code that they are potentially going to be pursuing here. That could be a boon for other AI names that want to train themselves off of DeepSeek's open source as well.
After years of the Mag 7 driving market gains, there's finally some broader participation playing out in the markets this year. The majority of the tech cohort taking a back seat. So who's leading the gains? Let's ask our very own Jared Blikre, markets and data editor, also host of Stocks in Translation. Jared, take it away.
Thank you, Seana. I got a really big number for you, $55 trillion. That is the total size of the S&P 500 market cap. What's market cap? It's total shares of a company multiplied by its stock price. You add all that up and you get $55 trillion, and that is up $2.2 trillion from the end of last year. And here's how it breaks down sector-wise. There are 5 sectors here, and you can see we actually have 6 more on this page. They're quite a bit different here, but I'll go through them and just tell you the biggest one, which we're going to take a look at today in depth, is financials. That's up over $537 billion. So basically 1/4 of all those S&P 500 gains have been concentrated in the financial sector. And we talk a lot about tech and some of the tech-related fields, but we have seen this broad participation. We've seen other sectors like materials step up, like healthcare step up. Now, healthcare is number 4 here. It's up $317 billion. And if you're wondering what these little white squares are, those correspond to the y-axis on the right, and that tells you how much the sector is up year to date. So financials are up roughly about 6%, and that's actually kind of middle of the pack for them. Energy, and I'm going to show you our other screen here, energy is number 1. That's up 8%, but as you can see, it's only a $96 billion gaining sector this year. It's much, much smaller than financials and healthcare and some of those others we were looking at. Industrials, that's also in the middle of the pack. That's up $205 billion. And another standout here is consumer discretionary. Now, that is a huge sector market cap-wise, but it's basically flat this year. It's only up $25 billion and has a flat return. And why is that? That's a Tesla story. So they also have Amazon in there, and Amazon, I believe, has been gaining, but the Mag 7 have just not been contributing a lot outside of Meta. One more note here before I move on. Meta is part of communication services. I was talking about that earlier. In 3rd place here in terms of market cap gains, and number 2 in terms of return. That has Meta and Alphabet, and that has just been a huge story recently, even though Meta just came off and had a couple of bad days. Now, here is the financials. So here's the financials sector and how it breaks down into industry groups, because there's a hierarchy that we can explore here. So we oftentimes think of banks as the financial sector. That's Citigroup, that's JP Morgan, Goldman Sachs. In fact, those are the biggest members, and so they get a lot of the press. They are up $192 billion this year. Financial services, we have those as well. Capital markets, those are some of the exchanges like NASDAQ and ICE, which owns the New York Stock Exchange, as well as some of the service companies like S&P Global, for instance, and Moody's. Then we have insurance. Insurance is a big part of it. A lot of times it gets overlooked, but that is a huge financial component that depends on interest rates and their structure, similar to how banks perform. And then consumer finance as well, although you can see that's the smallest. So let's take a look inside a heat map, and I have all of the individual companies, about 70 plus within the financial sector, and let's do a year-to-date total so we can see what's going on. What you're going to notice is, and this might take a minute because we got a lot of tickers in here. There we go. You're not going to see a lot of high flyers. If I sort by performance, the highest flying member, that's Citigroup. That's one of the big banks. That is up 16%, and that doesn't compare to some of the high double-digit gains we're seeing in some of the flashier parts of the market, but financials tend to be a lot steadier. And when we have a business cycle, the way we are in right now with the Fed lowering rates and an expected growth of the economy without a recession, that is an environment in which financials can thrive. And here is the biggest one. In the upper left, we have a mega cap. It's $1 trillion company. That's Berkshire Hathaway. And while it's not classified as an insurance company, it's somewhat of a conglomerate. It is definitely the biggest among this group. Then second, we have JP Morgan. That's up 12% this year. MasterCard and Visa, those used to be classified as tech companies in the GIC standard, but those are now financial, so you see those there. If I sort by performance again, you're going to see a definite bifurcation of winners and losers. The biggest loser here is MarketAxess. That's down 17%. That's like a bond market or credit exchange. But some other notable names. We have PayPal, that's down 11%. Private equity names like KKR or Apollo Global, our parent company, and some others, those are in the red. And again, the highest line here, which has some of the best returns, those tend to be some of the bigger banks. And with those, I would also throw in PGR, that's Progressive, that's up 11.8%. BlackRock is up 14%. So the list goes on. But I think if you take a look at the sector action year to date, I'm going to close on this. You're going to see financials have kind of surprised, and along with some of the other offerings that we have, and there's financials kind of the middle of the pack as we were talking about. Not the high-flying communication services, up 8%, home to Meta and Alphabet, but there's a lot of green in this space, and there's a lot to choose from. And I think that's the bottom line. Finally, in 2025, we have a lot of choices in the market which are doing well. Back to you guys.
All right, Jared, thank you so much, as always. Coming up, Nvidia's fourth quarter results on deck, what our next guest says the company needs to do to remain a core holding. You're watching Catalysts.
Nvidia is set to report fourth quarter results next week. Now, this will be the first report since the company officially started shipping its new Blackwell chips. Joining us now, we want to bring in Francisco Obito. He's FM Investment Senior Portfolio Manager. Francisco, it's great to have you ahead of these highly anticipated results that we'll be getting from Nvidia next week. I'm curious, what's the number one thing you'll be watching for?
Well, thanks for having me. I'll be paying lots of attention to the demand for the new Blackwell chips. That's one thing. And I'm also interested in and see if they're willing to discuss how foreign governments of the U.S. government is going to increase their spending in AI, if they have any hints where how that's going.
Do you anticipate that commentary being clouded by the DeepSeek of it all? I've wondered, because DeepSeek happened so close to some of the other big tech earnings, if Nvidia might have had a little bit more time to cook on a thesis in response to DeepSeek.
Well, it's not so much about DeepSeek, I believe, in my opinion. DeepSeek is basically a good thing for the AI industry. It's a way of making it widely available to many other potential users. And if anything, it just widens the ecosystem and accelerates the early adoption of AI. So it's a good thing. And I think what people fail to understand is that this is actually a good thing for NVIDIA as well, because the models are not done when you train them. You really got to refine them afterwards. There's post-training that happens afterwards, and you still need the big chips.
Francisco, what do you think the volatility is going to potentially look like?
It's going to be pretty wicked this year. And the reason for that is that it's not only the normal market volatility. You got to add about the uncertainty brought in by maybe tariff policies and those things. And some of that can be pretty disruptive. So we'll see where that goes. And at the very least, I'm expecting some volatility to come out of it.
I mean, it can be disruptive, but we don't have a lot of clarity on those tariffs. Like right now, the only tariffs that are actually in place is the 10% one on China and the 25% on steel and aluminum. Obviously, the deadlines are upcoming for the others, including sector-specific ones like chips. But how much can the market really react to that known unknown at this point?
Well, it's not so much whether they get implemented or not. It's just the threat of having them. That forces the people on the other side, or the countries on the other side, to think about the diversification regardless of whether they get implemented or not. So the impact is there, and the uncertainty that it creates is there already. It doesn't have to wait until they're implemented.
All right.
Sorry, Francisco, real quick, but my apologies. Before we do let you go, we also wanted to quickly discuss Meta with you, because there's been lots of questions about, after the massive run-up that we've seen, the record days in rows of gains, whether or not we could see a stock split. Do you think that's likely? And I guess how big of a catalyst, if we do in fact see one, could that potentially be for those future moves?
Well, I think, a stock split, it's in the cards. We couldn't discard that. Can we bank on it? Absolutely not. But, it's definitely there. Meta's going to continue to do well. It's going to continue to outperform as we go forward. It's just like, in my opinion, it's just a very solid business, and it's not yet fully monetized. I mentioned that in the past in prior interviews. And the reason for that is that I think they have many places they can poke for earnings, for organic earnings. So they haven't really addressed that yet.
All right, Francisco, thanks for joining us. Appreciate it.
Thank you.
Coming up, we're taking a look at the state of the consumer, specifically when it comes to retail. That's next, right here on Catalysts. Uncertainty about the state of the consumer and the potential impact of tariffs starting to weigh on retailers. Walmart reported strong fourth quarter results this week, but the big box retailer warns of slowing sales this year. Meantime, consumer sentiment data out today showing a sharp drop as consumer inflation expectations rise. Joining us now, we've got Stephen Yalof, Tanger CEO. Stephen, great to have you in studio with us. I just want to start on the state of the consumer. What are you seeing?
Well, first of all, thanks for having me on. Well, with regard to the consumer, I think the consumer was very present
and showed a great resilience during the fourth quarter. So our holiday sales, our holiday traffic were up. And, I think in both, we have a outlet platform and we also have a full price sort of town center platform that we're starting to grow. And the customer was definitely out and shopping in both of those categories.
Stephen, I'm curious when you take a look at, and I bring this up because of the consumer sentiment numbers that we got out this morning, this expectation for inflation to rise. Is that good news to a degree, or give you at least some sort of advantage over some of your peers, especially in the outlet division, when inflation is such a concern? Or what does that mean for your business?
I think the outlet business definitely benefits during any sort of macroeconomic headwind because the customer is looking for value. And when you can get, and the beautiful thing about the outlet center business, it's your favorite brands, but every day on sale. So if there's a consumer that's looking for an entry-level price point into one of their favorite brands, whether it's a luxury brand or sort of a middle brand, even Nike, it gives them the opportunity to buy the product they want at the best possible price every single day. And I think consumers really like that. They gravitate to that.
Over the, let's just say, past 4 years, how has the demo of your consumer changed? And I ask in the context of those Walmart earnings, because that's traditionally a lower income consumer that we're seeing struggling so much that they're struggling to even shop at a Walmart. We see that come up in McDonald's earnings, for example. Is the luxury outlet consumer more middle income or upper income?
Well, I think our consumer is looking for branded value. So they're not looking for commodity, meaning, sneakers at the cheapest price. They want Nikes at a great value price. So, our consumer going in is one who understands brand, and I think that that's critically important. On the higher end, I think that there's customers who may not need the latest product in the store, but want the product that they love, the brand that they love, the quality of fabrication. So in some of our stores, whether it's a Tory Burch, a Coach, a Michael Kors, or Ralph Lauren, customer can shop and buy actual product in those stores that at obviously a value price, but give them the opportunity to get that quality that they're looking for.
Stephen, what does the foot traffic levels look like?
Yeah, our foot traffic has been great. And you asked about the demographic of the customer before, but so let me relate that to foot traffic. We've done a really good job of bringing in brands that draw a younger consumer. The health and beauty category is really the category that the younger consumer is looking for right now. You see as many people from 5 to 15 shopping in Sephora and Ulta as you do, older people in those stores. And as those stores
That's
now
for those parents.
And as those stores start to come into our platform, we're seeing a much younger customer. And so now we're sort of catering to that younger customer because they're the customer of the future. So we want to make sure that when they come and visit us, there's plenty of things for them to do, whether it's a better restaurant, whether it's better entertainment, experiential things, better amenities. They love loyalty programs to get rewarded for the things that they buy. We've got a great loyalty program. And then, of course, the stores that they love when they come and visit us, that's the most important part.
How are you strategically thinking about that shift in the context of also wanting to keep the older demographic of customers happy and returning as well?
Well, sure. You never want to alienate your core customer. And as some of the brands that they've gotten used to over time start to lose a little bit of market share, there's still an opportunity for them in the platform. But what we're finding is that that older consumers also, their tastes are shifting as well. Now, there's been brands that have been in the outlet business for over 50 years. You look at Ralph and some of the other brands I just rattled off before. But I think there's a lot of newness that we're bringing in. Things like American Eagle and Aerie, their brands. Abercrombie doing an unbelievable job right now. J. Crew, brand that's been around for a really long time. But again, they're going after, they got that core customer, but they're also going after a younger customer too. So it's great to see, in our space, all age groups come together and have the opportunity to shop the same stores.
Stephen, I'm curious for your business, when you step back and take a look at the macro environment right now, specifically the Fed, there's risk here that we could be in this high for longer rate environment. What is that ultimately, the implications there for your business?
Well, for us, obviously, we're in a very acquisitive state right now. So we just purchased 2 shopping centers in the last 4 months. And buying shopping centers is how we're going to grow our business right now. Development, there's not a lot of new development happening in the retail space, primarily because the cost of building right now and the cost of land is so expensive. But you can buy shopping centers, particularly those that have come on the market, where we think we can add value
the pricing has been very advantageous for us. We've got a great balance sheet. My chairman likes to say we have a fortress balance sheet. We trade about 5 times debt to EBITDA, which is pretty low and gives us a great availability of capital, so we can go out and we can buy. Interest rates, as they trade up, they certainly will make the cost of debt that much more expensive, and obviously challenge a lot of the pricing. But again, for us, we look at going in yields. The last 2 acquisitions that we made were both in that 8% going in yield, but we think that we can also add a lot of value to our leasing, our marketing, and our operations over time.
On the policy front, there's also the potential impact of President Trump's tariff policies. What is the right strategic approach? Is it stockpiling ahead of potential tariffs, or is there a risk to that when it comes to inventory as well? How are you thinking of it?
Yeah, we've been thinking about that a lot, and actually we've been speaking to a lot of retailers and asking them what their strategy is, because it really relates more to the retailers than it does to us. But obviously you can't sell the products if they're not in the stores. What the retailers have said is that they've done a really good job of diversifying away from any one geography where they're manufacturing or supply chain. A lot of that work actually started post-COVID because there was a lot of issues getting things out of certain countries right after COVID. So a lot of retailers did a really good job diversifying their sourcing. And I think a lot of that diversification is still happening. I think the retailers that haven't done a good job with it, they'll probably suffer a little bit more. But fortunately for us, our largest retailers in our platform, those are the ones that I feel really good about their ability to not only source inventory, but fill the stores, which is ultimately what the customers are looking for.
Stephen, always great to have you. Thanks so much for stopping
Thanks for
by
having
after
me here.
earnings.
I appreciate it.
Keep right here on Yahoo Finance. We got much more coming up next. You're watching Catalysts. Warren Buffett's cash pile has hit record levels as the Oracle of Omaha trims some of his oldest bets and also makes a surprising new one. Let's take a look at some of the changes made to Berkshire's portfolio this past quarter. First up, Constellation Brands. Now, it is a brand new play for Berkshire. The company is scooping up a $1.2 billion stake that makes it the company's 6th largest shareholder of the beer and liquor giant. And this is a classic Buffett value play, the stock trading at just 10 times earnings, its lowest in more than a decade. And Buffett's buying, well, it did not stop there. He also added to his positions in Domino's, in Occidental, Pool Corp, SiriusXM, as well as Verisign. But it wasn't all buying. Buffett did raise some cash during the quarter. He scaled back his exposure. Some of the big banks, including Bank of America, Capital One, and also Citigroup. Citigroup was actually the largest cut of the quarter for Berkshire Hathaway. They reduced their stake by more than 70%. He also trimmed some of his holdings in Charter Communications, in T-Mobile, Louisiana Pacific, and New Holdings. And Berkshire did fully exit one of their positions, and that is Ulta Beauty, selling out completely after a very short-lived investment. Maddie?
Warren Buffett is a new fan of Domino's Pizza. Berkshire Hathaway first started buying shares of the company in the third quarter of 2024, scooping up more in Q4, bringing the stake to nearly 2.4 million shares. Now the pizza chain is reporting earnings on Monday before the open, so our very own Brooke DePalma is here with what investors can expect. Brooke, walk us through your anticipation.
Yeah, good morning. Well, certainly got a nod from the Oracle of Omaha this past quarter, Domino's Pizza, that is, in Q3. Berkshire Hathaway bought in 1.28 million shares, and then in Q4 they added an additional 1.1 million shares, bringing that stake to 2.38 million. And now that makes Berkshire Hathaway the 4th largest shareholder of Domino's Pizza, ahead of this Monday Q4 as well as the full year print. Now Wall Street expects that this fourth quarter will be a softer quarter here because of that bad weather. Citi analyst John Tower said that investors have already, or shares rather, have already baked that in, and they've sort of moved past that. Now they're really focused on 3 key areas. That includes challenges around their international growth. We know that their largest global franchisee, Domino's Pizza Enterprises, shared plans to close more than 200 unprofitable locations, with a majority in Japan. But on the upside, 2 long-term growth drivers that has Wall Street really excited here includes a partnership with DoorDash, the third-party delivery service. We know that in Q1, their exclusivity with Uber ends. We also know that third-party tends to be a higher income audience, so that is a boost to sales as well. And innovation here that also has the street really excited, guys. Innovation around stuffed crust pizza that could come by the end of this year, and that's one sales driver that has Wall Street really excited as well.
Brooke, how has Domino's been able to navigate navigate the inflation side of the picture?
Yeah, well, certainly that's something that we've discussed with them. They have this sort of upside here because they're able to play as a value player, and they're able to sort of offset those costs. They aren't really exposed to things that others are perhaps highly exposed to, like those eggs, like ground beef, like sugar. And so they've been able to navigate that, but also play in as a key value player within the space, and then they've been able to prove up against others like Papa John's, who maybe aren't winning in that space, or able to offer as competitive a value here.
All right, Brooke, we got to leave it there. Thank you so much for joining us. We really appreciate it as always. Let's get a check on the markets before we wrap up our coverage here today. If I can take a look at the major averages, you will likely see stocks moving to the downside here. We have the S&P 500, I believe, still holding on to a little bit of a lead above the tech-heavy NASDAQ. There we go. So the S&P 500, like I was saying, down about 0.6%, tech-heavy NASDAQ leading the losses today, down about 0.8%. If we can flip the board over to Treasuries, I'll be able to show you that yields are still coming in. Your 10-year still down about 4 basis points. That's really interesting in the context of that data showing inflation expectations ticking up higher. You would think that that could lead to a lift in yields as expectations for a higher for longer Fed to fight inflation come in here, but we're seeing those yields still coming in. One analyst on the street pointing out that could lead to questions about whether stagflationary concerns are hitting Wall Street amid those tariffs that could lead to a little bit of a growth shock moving forward, something that we have continued to cover on the show and will continue to discuss moving forward here.
Yeah, certainly it looks like some of that econ data that we got out this morning, consumer sentiment, adding to some of that, I guess, wariness or concerns out there on the street. And then, of course, when you take a look inside the Dow, UnitedHealth, the biggest dragger there, that, of course, on the heels of the report that we're getting out that the U.S. Justice Department is investigating some of its Medicare billing practices. Keep right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. Have a good weekend.